Hello and welcome to The Real Economy with a focus on the middle market and the economic headwinds facing it. I'm Gigi Stone-Woods, your moderator for today. We're going to be talking about interest rates, inflation, and the possibility of a government shutdown. We are joined by Joe and Neil of The Joe and Neil Show, Joe Brusuelas, Chief Economist of RSM, and Neil Bradley of the Chamber of Commerce. Thank you both for being here.
Good to see you again, Gigi.
Thank you.
You are both working hard to help businesses navigate these uncharted waters. And here we are facing the very real possibility of a government shutdown. A lot of people saying it is inevitable at this point. So how likely do you think this is, and what could the economic impact be?
Well, I'll let Joe take the economic impact if you want to start there, and then I'll talk about the probabilities.
Well, unfortunately, I think it does look more likely than not at this point. The simple fact is it's going to shave about 0.2% off GDP for each week. So if we use the 2018 shutdown, that went 5 weeks. Instead of being 0.7%, this will shave about 1% off GDP. Now, what that means is 4 million federal workers are impacted. 800,000 won't be reporting to work. You'll get several hundred thousand people who are government independent contractors. And the longer this goes on, the bigger problem it will cause. Now, one of the things in 2018 that didn't happen but almost did was that government almost ran out of cash to provide funds for the SNAP program, right? So the longer it goes on, the bigger of a problem it becomes. But one thing we do know is that people will get back pay. It will just basically take economic activity that would have happened in the fourth quarter of this year and push it forward really into the first quarter of next year. But nevertheless, there are other problems, and I think Neil's going to hit those really quick.
Yeah, as to the inevitability, I'm sad to say it does feel inevitable at the moment. We are in divided government. That means that to keep the government open or to reopen it in the event of a shutdown, it's got to be a bipartisan solution. You're going to have something that's supported by Republicans and Democrats. At the moment, the dynamics in the House of Representatives isn't permitting them to process a bipartisan bill. I think that leads us into shutdown. I think the question is it a 35-day shutdown like we saw in 2018, 2019? Is it a 16-day or so shutdown, more like what we saw in 2013? My guess today is it might be somewhere in between. There were a couple of factors that will help with the reopening. Tragically, after you get about a month or so into this, you do start seeing problems with things like food stamps. You see problems with the women's, infant, and children's programs for expectant mothers. You're going to have problems with the FAA and the Farm Bill program. So there'll be some collateral damage that will hopefully push common sense kind of back into this. Joe's right about the spending. Government shutdowns have never resulted in a reduction in spending. They simply move the timing of it. From our perspective at the U.S. Chamber, one of the really problematic things, though, is there's a lot of things that businesses rely on government to be able to do during that period. And when they're not available to do it, it means you can't do certain things. So, for example, we interviewed a fisherman in the New England parts of the United States. He's a scallop fisherman. He had gotten a new boat during the last government shutdown, and it was scallop season. You would think a government shutdown wouldn't impact a guy like that at all. Except the problem is to go out and operate a vessel during scallop season in federal waters, you have to have a certificate from the Department of Commerce. There was no one at the Department of Commerce to give him his certificate. He missed the scallop season and almost lost his boat. And there are just thousands and thousands of examples like that really impact the real economy.
Yeah, and even getting your passport renewed. There's so many different aspects of life that it permeates into.
Non-discretionary spending is equal to 3% of GDP. And one of the things Neil was pointing towards is lending, right? There's going to be lots of financial activity that won't happen. Fannie Mae and Freddie Mac won't be guaranteeing lending. Home loans will slow. So we'll notice that as long as this goes on, but we'll see. There's still some time. Hopefully they can come to their senses and they can solve this. But right now it looks like we're all getting ready for a shutdown starting next Monday.
So he's saying they need to come to their senses. Tell us about the political state of play and who's driving this.
Well, you have a small number of individuals in the House of Representatives and on the majority side who think a government shutdown or the threatening of a government shutdown is an opportunity to gain leverage for their policy priorities against the democratically controlled Senate and obviously the White House, which we have a Democrat as president right now. They're not the first to think that. In fact, this would be, the fourth shutdown in a decade that we've had. Some shutdowns have been instigated by Republicans, some have been instigated by Democrats. They all have a very common theme. You have a minority within the Congress who wants to force change upon the Senate or the White House or the House of Representatives coming from the Senate, and they think that withholding funding for the government is a way to force that change. The interesting thing is, while it's been started by R's and D's in the past over different issues, all the prior shutdowns have one thing in common. They've never actually succeeded in changing public policy. So from our perspective, this is a very failed legislative tactic, and unfortunately one that has real-world consequences for lots of people.
So the possibility of a shutdown could put pressure on an already precarious economy. We do have this light at the end of the tunnel. The Fed's saying we are not headed for a recession. They have managed to orchestrate the soft landing. What is the probability of a recession at this point?
Right now, we estimate only 40%. And given the dynamics that we're seeing in the economy, it's likely going to come in around 3% growth in this quarter. That probability is likely to diminish going forward, even with all of the risks around the outlook, in particular rising oil and gasoline prices. So we're in a very good position, and that's the unfortunate thing about this, right? We're growing more confident by the day that we're going to stick the landing on this. We're not going to have the recession, even if we just sort of muddle through the final 3 months of this year and the first 3 months of next year. After that, we see growth going back a little bit above 2%. That's the long-term trend is 1.8, so anything above that's good. The labor market's going to remain historically tight. Wages are now rising above inflation. So we're all moving in the right direction. This is what you want to see in what we can at least charitably say the post-pandemic era.
Well, oil and gas prices rising is a real economic pressure, and it affects everything from airline fares to the cost of trucks going up, cargo across the country. Where do you see oil and gas prices going, since you mentioned it?
Okay, well, it's impossible to predict. They're up 30% over the past 3 months. Now, my sense is we got a combination of financialization, lots of trading, lots of noise, and real global supply problems. And when you think about oil, you think supply, supply, supply. Now, my sense is we have a little bit more of a ways to go, and then we'll fall back to somewhere probably in the 80s. Oil's not going to go to $140 or $150 a barrel. That's where the consumer starts to crack, and that's where the economy gets in trouble. Remember, June 2021 is when we had the initial shock, and we went up above $150 a barrel globally. That's when gasoline prices went to $6 a gallon, and that's where the consumer cracked. We're just not there yet. We're still, regular unleaded's still, $3.50 to $3.80 a gallon there, I think. So we're doing quite well on that, even if no one's happy with the price level of anything right now.
When you think about it, our economy here in the United States is remarkably strong. I think, as Joe pointed out, the chances of recession falling, we're showing the resilience of the economy. That's not true for the entire world, and so there are a lot of question marks, particularly around China and what this means. And I think not only is that a question mark for future oil prices, it is some of the things that will put downward pressure on prices going forward.
What are you hearing from businesses about how this is affecting them?
I don't know that we're at a point, to Joe's point, where none of us like paying more when we're filling up our cars, but I haven't gotten the sense that we're in this moment where it's a significant unexpected drag on other sectors of the economy.
I think it's more of a conversation about where the economy's at, the price level. It's coming to grips with the fact that we've had an inflation shock. The price level's not dropping, even if inflation's slowing. And there's a second different conversation around what this means for the election, and that's where most of the noise is. But when I go out and talk to firms, no one's bringing up the price of oil or gasoline. They're talking about the cost of financing, which is a very different set of conditions.
So how are businesses coping with the cost of borrowing being so much higher than it was 18 months ago?
Well, they're muddling through. No one likes it. They're finding it very difficult to find financing. Inside our special third quarter survey on financial conditions across the real economy, one of the main takeaways was we found that 36% of the respondents who needed to tap financial markets were moving towards the shadow banking system, where rates can sometimes be well above 15%. That's a sign of financial stress. It's one of the reasons why the central bank is a little bit more reticent about talking around future rate hikes. As a matter of fact, I think they're done. We think they should be done, because when you've got good privately held firms with good balance sheets paying anywhere between 10 and 15% on average, just to meet payroll and finance expansion, that's probably not where you want to be. And that, most in our estimation, indicates a potential tipping point in terms of the economy. So we're optimistic that we are either at the peak of financing cost, and with the Fed telegraphing at their meeting that they're going to cut rates twice next year, we think probably the second half of the year, I'm optimistic about what 2024 is going to look like.
We have this new normal of interest rates being higher for longer, right? What advice do you have for businesses who are coping with this?
Well, first, I think a lot of businesses saw this coming, right? This wasn't a complete shock or a complete surprise. So in some ways, they were able to plan. What they haven't been able to plan for is duration. And so I think the real challenge that companies face today, particularly that need financing, we're expecting need financing over, say, the next 2 to 3 years, is how do you plan for that? Are we really going to get the rate reductions that people want to see out of the Fed? Will there be a new normalization? Where does that new normal land? And so I think what our advice to companies is that you have to have kind of a range of plans to adapt for that. That you're not going to be able to say with certainty the direction of where the Fed's going to go. You have to have a probability spectrum that allows you to have multiple classes of financing going forward.
So if interest rates go up, how much is this going to affect things?
You'll see a margin compression. Earnings won't look quite as robust as they have, and you'll see the economy slow. Now, we don't think that means a recession immediately, but we'll see just how far rates continue to rise, with the 10-year sitting at 4.5%. More importantly, the real yield, using the 10-year TIPS as the benchmark, sitting at 2.12. Now, that's in contrast with the average of 0.26 over the past 10 years. That means we're in a different era. Now, for those of us who are old enough to remember what the world looked like prior to the great financial crash and the unorthodox monetary policy that was put in place, well, this looks quite familiar. We can do quite well under this rate regime, but there's going to be a transition. And that's what I think people are a little bit nervous about.
Who's this going to hurt? What does it mean for banks?
All right, so the banks. Well, we did see some collateral damage earlier this year. It's in the local and regional banks. We're going to want to look at unrealized losses on balance sheets going forward. And the Federal Reserve, who oversees the banks, they're going to have to sit on these banks to make sure that their balance sheets are in shape, the stress tests are meaningful, and we're ready for any unexpected occurrences. My sense is the larger banks are in for a period where they're just not going to be quite happy about who's bearing the adjustment cost on this, because it's going to be the big banks.
Yeah, listen, I think as we saw in the spring, we had instances in several banks where they had a mismatch between their assets and their liabilities, and they got caught in that. And so that's not true of most banks. And in fact, for those who even had slight mismatches, thanks to the Federal Reserve and the Treasury, we now have facilities to help them manage through that. It's not that the underlying assets were fundamentally impaired. As we go through this transition, there certainly are going to be some sectors that are going to have higher defaults than what they otherwise would have anticipated. Our sense is that banks are well positioned to absorb those additional losses. I think one of the things that we have to decide kind of as a country, what policymakers have to decide is, are we confident in our stress tests and what we've done and the current bank balance sheets, and such that we want to regularize more stress tests, we want to make sure that people actually do have assets that can absorb the losses, or are we going to do that and add new capital reserve requirements onto the system? To me, that's where, and you even see some dissent within this, within the Federal Reserve, that you could end up having policy that fundamentally dictates the availability of credit to otherwise worthy institutions, and that could have certainly some negative unintended consequences.
And let me say something that might not be broadly popular here. We're going to need venture capital and private equity to help us work through that transition. We're going to need that cash to come off the sidelines, and policymakers have to be sure they don't put onerous regulatory or create a more onerous regulatory environment than there already is, because these are firms that operate on leverage. Leverage is just more expensive as rates get higher. But there are companies out there who quite charitably could be called zombie companies, who we're going to need to help work through and get to that other side. You know, we went through this in the early 80s. We went through this again in the 90s, early 90s, when rates were much higher before we had the dot-com positive productivity shock. So we know how to do this. It's just a matter of getting on with it.
Okay, another big story of the day we have to talk about, possibly putting pressure on the economy, is the United Auto Workers striking. President Biden, in an unprecedented move for modern times, joining them. What is the potential impact of a UAW strike?
Okay, so the potential impact could be quite large, right? I mean, if the entire network of labor went on strike, but they're not. Right now, we have roughly about 12,700 people who are on strike through this morning. Now we're going to get a much bigger number. We have 2,600 people who've been laid off because of it. So right now, this isn't going to create the economic impact in the same way it's talked about. But we'll have to see how it evolves. So I really don't see much more than a modest drag on overall growth. I mean, very modest, almost barely there, given the current dynamics of the strike. Now, should it become much more widespread and the entire population walk out, then we've got a much different number to talk about.
I think there's two things you have to look at. To Joe's point, you have to look at the actual strike, the UAW strike, and if it's contained, if it's modest, exactly right. There are spillovers. It's a very micro impact, not just at those individual companies and the plants and facilities and their supply chains, but people in those communities, the restaurants, the diners that serve people who would otherwise be coming in because they were going to work. That has real consequences for those folks. I think the second level you have to look at, though, is what this strike kind of tells us and what the president's visit, frankly, tells us about the broader labor movement and some of the push on employers. So reporters have started calling this the summer of strikes. That's because throughout the year thus far, we've had over 200 significant strikes against various employers. So it's not just the UAW or the screenwriters and actors out in Hollywood. You're seeing a lot more pressure being put on employers by the leadership of organized labor. You see the demands getting kind of higher and higher, and that's going to add to wage pressure. And so I think a little bit of what we're sensing here is this a moment where union leaders feel emboldened, including by the president's visit, to kind of make demands that frankly may not be able to be met in reality, but to the extent that people feel like they got closer, does it cause copycat strikes? Do you see a lot more activity, which in total could be more destabilizing to the economy and future economic growth than any individual strike?
UPS had some success. American Airlines had some success, and that
Big
creates
numbers,
the sentiment
big
to grow.
numbers on those deals.
It looks like the Screenwriters Guild also had some big success last night.
Possible, yeah.
We want to put this in perspective, though. Only 6% of the private sector workforce is unionized. This is just not 1950, right? I mean, we have a very different economy now. So while it's important we address this, this is at the forefront of business because labor usually accounts for 70% of all business cost. And in Detroit, they know that per unit of production, their transaction fees are around $51,000. So they're going to watch that wage number like a, with like a hawk, right? They're going to have extreme focus. But my sense here is that overall, this won't disrupt the economy. And I know it's hard to sort of, for people to believe that because auto production is important. It's just not what it once was.
How do businesses navigate this, though? I mean, we saw the issues with Yellow. These are tremendous costs for a lot of businesses that you talk to.
Well, they're huge costs, and they're very difficult to navigate, particularly when people are, when they're negotiating with a union that saw another union get a 36% pay increase, and they're looking at their numbers and saying, if we do 36%, we'll cease as an ongoing operation or cease to be competitive over the medium term with our competitors. So there's a real balance that employers have to strike here. We are in an unprecedented kind of period of labor tightness. We are quickly running through the people that we can really bring off the sidelines to make a measurable difference. As Joe said earlier on, this is a little bit of the new normal when it comes to the workforce. So I think it is a tremendous challenge for employers, particularly for those who have to negotiate with the union, to figure out how you balance increased demands in a tight labor market with the financial viability of your company, particularly in a period of changing interest rates over the medium term. And I think, I suspect we will find 5 years from now that some companies did a really good job navigating their way through it. Some of them made a lot of promises that put them in real peril.
It really will be interesting to watch it all unfold. So we're talking about all of the possible things that could derail this economic growth. One thing that is coming up that also might put some pressure on the economy is the resumption of student loans, October 1st. They will have to start being repaid. That puts a little pressure on household consumption. What kind of effects could that have?
Well, I'm a lot more optimistic, I think, than most of the economic analysts or the Economist. So I'm in the Economist camp. It's a modest drag. It'll be about 0.3% on GDP during the fourth quarter. What's interesting is the repayments already started. We can see the cash deposits in the Department of Education are now above where they were pre-pandemic. Moreover, it's quite easy to delay your payment. It's quite easy to qualify for income-dependent repayment. So I think some of the hysteria around it can shave off 0.6% or more to GDP in the fourth quarter are overwrought and overdone, right? Moreover, when we went and looked and decomposed where the level of loans is above 20,000, it's all way up market. People who are above 110,000 and above 250,000, these are doctors, lawyers, engineers, people who got MBAs. They actually can afford this, right? And my sense is most of them continued paying during the pandemic. They just weren't paying back interest rate because interest rates were held in abeyance by the government. So this is not going to derail the economy. And let me just say something. We're having an unfortunate conversation in this country around higher education. It's not the worst idea if you've qualified to go to a school and you're not a person of means that your 18-year-old self borrows something from your 35-year-old self because you're going to get an education. You're going to make 5 to 10 times more than a person without. And it makes sense to go into a little bit of debt. It's not the end of the world, right? And you can pay it back, and you can pay it back over a reasonable amount of time. That makes it so you're not really feeling put upon. Now, understand we have a lot of people who didn't finish school. I understand some people were taken advantage of by for-profit colleges. And every once in a while, we're going to have somebody...
And skyrocketing costs across the board.
That's right, yeah. Every once in a while, we're going to have somebody who went to graduate school who didn't finish, didn't get the job they want, and they're $70,000 in debt. I understand that. But those are anecdotes, but not the reality. The reality is most people have a very small quantity of debt, and they tend to come from places where there wasn't a lot of money in the family. That's how we do things. We're going to be better because of them, and we have to teach them how to take those risks. So the restarting of student loans, not the end of the world.
Ditto. I agree 1,000%. Listen, this is, it's a place where we don't really have great market forces. Yeah. We have great market outcomes because of the ability to get an education and translate that into higher earning potential. If we were really focused on kind of addressing some of the problems, some of the things that we would do was focus our attention on the individuals who are likely to take out student loans or did take out student loans and aren't likely to complete their education because they are really dragged down with that debt without the benefit of the return of the college degree. And we have to be very mindful and have policies that address that. The second thing we do is just have a lot more transparency about the good schools, the bad schools, the good majors, the bad majors, helping people make
some
informed
accountability
decisions,
as well.
having some accountability in that system. That would be a fruitful conversation. The current conversation about student loan forgiveness is not especially fruitful for the economy or frankly, for most families.
Well, while we're talking about the effect on household consumption, there's a disconnect, and you mentioned it earlier, about how we're hearing inflation is cooling, and yet the average American household still has their same costs that are higher, just like they were a year ago, so they're not necessarily feeling that yet. So how do you reconcile that?
The median family is facing somewhere around $750 in additional cost following the inflation shock that started during the pandemic. Okay. The price level has moved up, and it's not going to come back down. It's just the rate of growth will slow to a more tolerable level. So right now, they're just, the further down market you are, the more difficult this transition is going to be, even if your wages actually allow you to do it. No one likes to go to the store and pay what they're paying for milk, eggs, butter, chicken, and beef. They don't. But we're all going to get on with it at one point. You become habituated to it and you adjust. The best scholarly research tells us that after an inflation shock, once inflation's receded to about 3 to 4%, the public just gets on with it. Doesn't mean they're going to be happy. Doesn't mean they're not going to complain about it, but they're going to get on with it. And when we think about the relationship between consumer sentiment and spending, we tell people, look, watch what people do, not what they say. The soft data is the sentiment data. Everyone's angry for a lot of reasons. The hard data, spending, well, that's looking quite good. We're going to have over 3% spending in the current quarter. We're going to get a report on Friday on August spending, which should be up about 0.6%. I don't know about you two, but that doesn't look like a very stressed household to me. So there's something going on out there, yeah.
Joe said two important things that deserve to be emphasized. The first is that sentiment data used to be somewhat useful in understanding the directions, particularly forward, what were people's attitudes, because you could kind of translate that into likely future activity. I hate to say it, but a lot of sentiment data has just become useless. It tells you nothing other than, in this moment, people are angry, but they're not actually acting in the way that the sentiment data would tell you that they were likely to act. So if folks are over-reliant on sentiment data, that's probably a bad strategic decision. The second thing, and I think this is part of what fuels that, is if we're having an honest, non-political discussion about inflation, what Joe just said is exactly right. It falls, but we're still talking about 2 to 3% price increases. We're not talking about deflationary, where all of a sudden the price that you pay at the grocery store today for the same items that you have in your basket is equal to or below where it was 3 years ago. And you turn on most news stations, and it is a price point comparison for a slab of bacon or a dozen eggs today versus where it was in whatever political moment in time they want to draw a comparison to. That's not the real world. That's not how this works, but it does fuel some of that negative sentiment that's just not grounded in people's reality.
How do you help businesses navigate inflationary pressures, or what is coming down the pike?
Well, I think when we think about what's coming down the pike, one of the things that we have to really think about gets back to this discussion about labor. So, if 70% of your costs are labor, if the labor shortage isn't going away, the things that you should be concerned, if you were concerned about supply chain and inputs because of the pandemic and the disruptions there, and you should have been, that was a major source of some of the inflationary pressure at that moment, you should be focused on what's going to happen with labor. And that means, how are you going to meet your labor needs? How are you going to use technology and automation to substitute for some of those, what traditionally was labor needs, so that you can control your own costs? And I think that is a fruitful place for businesses to focus on.
I really empathize with the people who run businesses, especially, small and medium-sized enterprises. You have to be engaged in a different way, quite frankly, than you were before the pandemic, right? You have to understand that those supply chains, they were shut down. They're not going to come back in the same way. They're not going to look the same. You have to diversify on an active basis where you're getting your key inputs from. It's a little like a well-managed portfolio. You have to diversify everything, not just your necessary goods that are your inputs, but also your labor. You have to know what's going on in artificial intelligence and other forms of machine learning Because if there's an opportunity for you to engage in a little substitution of technology for labor because you just can't get that labor, you've got to make that investment. Even if your confidence may not be there, you may have to hire some people to help you run it, but over the medium term, you really don't have a choice. That's a very different set of constraints than your average CFO or CEO would have faced prior to 2020, but yet here we are. So we're having these very different conversations with our clients and with our friends. So Neil's right on, just right on, spot on this.
Okay, speaking of our clients and our friends, one of the things I love about this show is that we have this very interested, informed audience. It's a testament, I'm sure, to the excellent advice you guys give, but they have some really good questions. So I'm going to turn now to some of the audience questions. So I think this is more directed, actually, at both of you. What are a few of the likely scenarios, this is from John Foster, what are a few of the likely scenarios for the economy given different election outcomes?
Well, let's start with the election and what we know based on kind of modern current trends. So we have federal elections in the United States every 2 years. If you go back from 1960 to 1998, in that period of those 20 elections, only seven of them actually resulted in a change in control in the House, the Senate, or the White House. It was a period of pretty significant stability in policy making and direction. If you go from 2000 to today, 10 of the last 12 elections have resulted in a change in control in the House, the Senate, or the White House. We are looking at an election in 2024 where the White House is clearly up for grabs and there's fierce competition. It could go either way. The same is true for control of the House of Representatives. The same is true for the Senate. Irrespective of what kind of coalition is kind of put in charge coming out of the 2024 election, you can expect some level of change, which is going to create more uncertainty in the policy-making environment. So because we're in this constant moment of shifting the makeup of our government every 2 years, we're constantly shifting the direction of policy. That includes regulatory policy, so broadband services are regulated like a public utility under administrations of one party, not regulated that way under administrations of the other party. If you look at taxes, very different fundamental approaches to taxes between the two parties, as we're facing about a $3.5 trillion tax cliff at the end of 2025. So I wish I could predict to you kind of the scenario that the election is going to produce and exactly how that translates into policy. It's a little difficult, but the thing I can assure you of is it's going to be more uncertainty and more churn. That ultimately is not very good for business.
And either way, the changes would be very significant.
So
potentially very significant.
one of the major economic tailwinds for the economy over the next 3 to 5 years is the policy tailwind on the CHIPS Act, transportation, infrastructure, and then IRA. And what I call a status quo plus outcome. I just don't see a lot of that changing regardless of who wins, simply because it's a form of industrial policy for good and for bad. But right now, the Washington consensus is not the neoliberal free market, free trade, free flow of capital that Neil and I may actually prefer. It's something a little different, and it's organized around something called industrial policy that both parties appear to be committed to. So from that point of view, I don't expect much change in terms of the drivers of growth. Now, what Neil said on the regulatory side, well, that could be very different.
It's in some ways we try to, a lot of people overlay their political position into what that means for business and the outcome. And certainly there are differences between the parties and different policies move different directions. One of the interesting things for us is to watch this uncertainty and concern about the direction of public policy often going in different directions. So for example, we released a report at the U.S. Chamber earlier this year where we looked at the S&P 500 10K filings over the past decade. And as you know, companies have to disclose risks. And normally it's dominated by business risks. So disclosures about changing consumer sentiment or interest rates or exchange rates, all reputational risks, all the things that businesses manage. And those continue to dominate. But if you compare a basket of risks that are traditional business risks that you manage versus a basket of public policy risks, changes in regulations and taxes, legislation from Congress, what you find is over the past decade that business risk is essentially flat up 4%. It's got some ups and downs over the course of the decade. Government as a source of risk is up 27%. And it doesn't really matter whether you're in a Democratic administration or Republican administration. This churn, this change in direction of policy means it's something that businesses have to pay attention to.
We have a follow-up question on our conversation about consumer spending. I understand that the hard data shows consumers aren't hurting. However, credit card balances have ballooned. Is there concern this spending is unsustainable?
No. I know that there's $1 trillion in credit card debt out there. That's just another number in a $27 trillion economy. And most of it is actually upmarket consumers who use it to pay for their basically daily needs and then pay it off at the end of every month. It's just a lot of churn. It's not representing what I consider to be a major risk. Moreover, when you look at those upscale consumers, they have over $500 billion in excess savings. I think those people are well positioned to address that debt.
And we have a question about residential real estate, which we have not really touched on. What is the possibility of a residential real estate crisis with high interest rates and increasing prices for both purchasers and renters in certain areas?
All right, here's where we get to be old men. My first mortgage was 8.5%. Mortgage market was fine. There wasn't a problem. Well, I'm empathetic to younger people who are going to go through this huge adjustment where they saw mortgage rates of 4.5%, and then during the pandemic at 2, 3, and 4%. Okay, that's now passed. We're going to have mortgage rates between 4.5% and 5.5% once we get through this period. No one who's a Gen Z is going to be happy about that. But we're not going to have a residential real estate crisis. What we have is a lack of supply. Now, that's not something the Fed or the federal government can do. That's profoundly local. Instead of not in my backyard, we need to have yes in my backyard. I built a brand new home over the last couple of years. We need more of that. Until we get that, housing is just going to be a little bit tight. People aren't going to be happy about it. And we'll see what the local areas do. My sense is if the average age in the country is 38, that's millennial and Gen Z, they're slowly taking over. They will begin to assert power at the local level and arrange public policy to accent their preferences, which will clearly be more supply, not less. That's how we'll solve the problem, but that's a multi-year issue.
What steps can be taken to increase supply?
Well, it really is at the local level. It's zoning and permitting are some of the most significant barriers. Density, we have in a lot of parts of this country, particularly in cities and suburban areas, where you actually need most of the new housing. We kind of had this antiquated view that we want single-family homes in large swaths of the area and no density. And that's a real problem because there's only so much land in those areas, and if we're not adding to density, it becomes really hard to add to supply. So we're coming to you from Washington, D.C. right now. It is a real problem, not for the core in downtown D.C., but just the very near-end suburbs. There is an aversion to density. It's playing out in the public debates and the city councils and the county commissions around here. And at the moment, it's not going the right direction. So those are the policies that we need to change if we actually want to hope to add to supply, which is the key to making it more affordable.
And here's something where the federal government could help. Trump administration put a tariff on Canadian softwood lumber. Biden administration refuses to remove it. Canadian softwood lumber accounts for 40% of all the wood used in housing. Maybe we should repeal that tariff, go back to the free trade arrangement, which will help on the margin reduce cost of housing, right? We know how to do these things. We just choose not to do them.
Well, we would be remiss if we had this whole conversation about business and didn't mention AI once. So we have to thank Matt M. for bringing up this question, which is, what is your view of the role of AI as a productivity driver in the face of higher labor costs? Will there be a sea change shift to capital investment? Intriguing.
Yes, yes, and yes, but it will be slower than what we think. So when I think about AI, I think about machine learning, predictive analytics, econometrics, statistics. These are all the things we already know how to do. Corporations are already integrating this at various stages and intensities, and it will help produce a productivity shock. Now, how we integrate generative AI or large language models into what we do, that's yet undefined. I think another productivity shock there. The third pillar, generalized artificial intelligence, where the AI really begins to solve sophisticated physics and engineering problems that we can't yet. It's still a ways away. But yeah, this is going to help. Look, we don't have enough people in this country to fill the jobs. There are 8.8 million jobs available. There are 5.2 million people actively looking for work. And get this, we have 4 million people working part-time for economic reasons. At a certain point, AI becomes part of the solution, not the problem. Now, I'm empathetic to people who think the computer is going to take my job. Well, we just have lots of churn. There's always lots of sophisticated technology that's integrated into the production of goods and provision of services that causes change. But I don't think it's going to cause widespread mass unemployment the way it's being presented, unfortunately, in the media.
I'll say something contrarian. If you asked me to say, what are you more worried about? AI moving too quickly or AI moving too slowly? Most of the conversation in the country today, certainly here in Washington, D.C., is a fear that it's moving too quickly. My biggest fear is that it's actually moving too slowly, that we won't be able to take advantage in the time that we would hope to some of the productivity gains. So I think about a sector like healthcare, one that's highly regulated in terms of medical devices and approvals out of the FDA, and we're looking at the retirement and the aging of the baby boom generation combined with severe shortages in the medical professions. And when you think about the ability of AI, including from large, we call them language models, in this case it'll be diagnostic templates, it'll be blood tests and radiation, radiological outcomes, and their ability to speed up the diagnosis of individuals and diseases and ultimately to point to physicians in the direction of a treatment that reduces the amount of time they have to spend on each patient. I'm worried we're not going to get there fast enough. I'm worried that government may end up being part of the problem and that we're going to miss out on the ability to really get the efficiency gains at a moment in which we're going to need them the most.
Well, it won't be due to a shortage of spending. We had Amazon just announcing it's getting into the AI game with spending billions of dollars on its version.
You know, and when you see AI announce that they're going to hire 250,000 people ahead of the holidays, you understand why they're making those investments, because that internal demand doesn't go away, even if people are a little bit uncertain about the direction of the economy. But like I said, we're growing at 3%. We grew at 2.5% through the first half of the year. We're going to do quite well. We're going to need more people, and technology is going to be part of that solution.
You mentioned possible government intervention in AI, and that is someone's question. How do you see government regulating AI, ChatGPT, et cetera?
Well, so I think first is that if you have kind of models, and if you look at the Chinese model, for example, which is a very authoritarian control, in AI they've restricted consumer access. They want it to be B2B, which is really G to G only. That's a pathway towards disaster. If you look at the European model is much more of a government permissive, may I approach that doesn't have the negative effects that you see in the Chinese model, but it ultimately slows new development and new technologies and innovations and applications. Versus what we hope will be an American model here, and we're still in the process of figuring out the direction that the United States is going to go here. And the direction I hope we go in is one not that dissimilar that we took in the 1990s when the internet was the new technology. We want to fill in gaps that exist within existing laws, and there are going to be some gaps when it comes to AI, but not near as many as people think they're going to be. And so let's have a little bit of a light touch regulatory approach. If we have that light touch, gap-only focused regulation, I suspect we'll get a lot more innovation and a lot more good coming out of AI if that's the approach we go down.
Let's hope. Sounds optimistic, but we'll hope for that. Okay.
I was going to say, never discount the ability of Washington not to be able to do something. And in this case, we're largely asking them not to do things. We're not asking you, don't adopt the Chinese approach of command and control. Do not adopt the European approach of excessive regulation and government permission granting. Let the markets figure this stuff out. You're going to find along the way there are a few discrete things that aren't covered by our existing laws that you want to address. But take, for example, discrimination. People are worried appropriately about discrimination getting embedded in AI. We actually have great anti-discrimination laws in this country. They're already applicable to when you're using AI services. The best thing that we can do is apply those rather than attempting to go in and write a new discrimination law for things that are produced using artificial intelligence, because then all we're doing is writing a technology-specific answer that's likely to be out of date by the time Washington gets around to passing it.
Really interesting points. All right. Lots of dialogue of longer neutral rate, I'm reading here, of 2.5% to 3%. What does this really mean for risk-reward considerations for the average investor and economic growth?
Well, what it means is that the U.S. economy is going to be able to grow at a little bit of a quicker rate than what we've been accustomed to, but it will require higher interest rates. So the leverage that you could have employed during the period of zero interest rates on a nominal basis and real negative interest rates is going to be less. So investors are going to have to not just be risk averse, but they're going to have to be risk aware, right? It's going to require a lot more legwork in terms of what you're looking at, understanding of the company and the management, as opposed to we can count on a steady stream of liquidity just to cause markets to float up. I mentioned earlier when we were talking about oil, over the last 20 years, about 30% of the price of oil is just due to financial activity. It has nothing to do with actual supply or demand. Well, as you get that higher long-run neutral interest rate, it will be more difficult to leverage up, borrow money on the margin in order to support speculative activity in commodity markets, right, which are notoriously volatile and speculative driven. Okay, I would say that's probably a good thing on net. That way we don't run into these issues where the oil prices just jump for no apparent reason and then fall, which is what I think is going to happen around this particular episode of oil prices increasing 30%. Essentially, we're moving back towards what I would consider normal financial markets, where there's a positive sign and a price attached to the cost of borrowing and the cost of money. That's what you want. The only reason why we were in that mess was because we had a near depression type shock in 2007, 2008, and we had to do that. That era is now over.
You get a lot more discipline, right?
Yeah.
And discipline is not a bad thing when it comes to investment. In some ways, the era of zero interest rates mean that we were all searching for yield. Traditional avenues were closed off in many ways of producing lower risk yield, and we became undisciplined. And so this is going to restore some discipline. It's going to restore more options for investors to have higher low risk yield. That ultimately is a good thing for a stable, growing economy.
And maybe, just maybe, some of the speculative funds that float into more esoteric, risky areas of the market are recycled into, say, productivity-enhancing investment, not just providing dividends to investors, but higher wages to workers. And that brings us full circle, on the strike. We're in a period now where we're short labor. We're going to be paying people more. Yeah, that's one of the things management's going to have to adjust to.
We talked about the implications of the possible election outcome. What are the political and policy considerations as we head towards the election?
Well, listen, I think it would be nice if the economy was more prominently actually featured in the election. It was interesting, if you watch the first Republican presidential primary debate, despite the fact that polls said that the election was the #1 issue, including for Republican primary voters, there wasn't a whole lot of discussion in that debate about what candidates saw as their role and what they were proposing to do for the economy. I hope that's not true in future debates. It would be nice to have a real discussion, in part because we have real challenges that we're not talking about. We're not talking about the labor shortage challenges and where we factor immigration, legal immigration, into that. We are not talking about the federal government's debt and deficit. We were talking quite a bit today about what interest rate normalization means for companies and for individuals. It also has huge implications for the federal government in many ways. They have benefited from a decade of low interest rates that have really covered up the fiscal imbalance that's going on. We have to have a real conversation about what that looks like and the fact that Social Security and Medicare are running out of money within the next decade. These are solvable problems, but they still require solutions, and unfortunately no one's talking about those solutions.
Yeah, it would be nice if we had a discussion around lack of labor, tight financing, and the 2025 tax cliff that's coming, but I'm not holding my breath. You know, what said everything for me was when I saw that the administration was going to deploy the governor of California to talk in the post-spin room. Governor of California is particularly adept at cultural politics. Seems to me the election's more about the cultural disputes we have around the country than around economics and finance.
But Joe mentioned something that deserves what should be front and attention in addition to that is this tax cliff we have at the end of 2025. And so if your business is organized as a pass-through entity, not only are the individual rates, which are the ones that apply to your business, going back up at the end of 2025, that 20% pass-through deduction goes away, and you have a lot of other benefits that accrue to individuals, families, households, and employers, about $3.5 trillion worth over the course of a decade that expire midnight December 31st, 2025. We've been through some of these tax cliffs, although much smaller ones before. They didn't turn out that well, particularly for companies who are large employers in their areas. Thinking about the 2013 tax cliff, I worry that we don't have a great plan for figuring out a sustainable revenue structure that's good for economic growth, that doesn't discriminate between pass-through businesses and publicly traded companies, and that is financially sustainable for the United States government over the long term.
You know, Gigi, what's interesting is if you go around town and you talk with people, there's a rich and substantial, very quiet conversation about this. It's just never going to be in the forefront of where it should be in the election. We're going to have discussions around other things, truthfully, are second-order questions. The economy and finance should be first, and it's just not going to be, unfortunately.
Well, while we're forward thinking, you know, we talked a little bit about it, but where do you see the economy going? We're talking about 2025.
Well, I think that we're going to grow just above the 2% trend next year. I think things are going to look very good simply because more people getting better jobs, making more money, you tend to have a better economy. Moreover, I think we've turned the corner on productivity. Maybe I'm a little bit optimistic here, but I see us going through a modest productivity shock over the next several years, in part due to things like artificial intelligence and the realization of many firms that they couldn't wait and be behind the technology curve. They had to begin to invest, and we've seen that in our own survey on a consistent basis over the last 3 years. And that, to me, is very optimistic, constructive, and encouraging.
The dollar showing surprising resilience.
Yeah.
What about global pressures on the United States, on the global economy?
You know, the U.S. is outperforming everybody but basically India and a small handful of emerging markets. I think the conversation in terms of global is going to shift tremendously, simply having to do with the debt and deleveraging crisis going on in China. China's in a little bit of a difficult predicament, not too dissimilar to what we went through between 2007 and 2014. Once a debt and deleveraging crisis starts, they've got a debt hangover in their housing sector, in their banking sector, and they've got a debt problem, not the federal, but the state and local. IMF thinks the local cities have $66 trillion in debt. Once you embark on a debt and deleveraging cycle, it takes 7 to 10 years to go through. Now, they're about 2 years in it. They've been attempting to do what some in finance would call stealth deleveraging, but you can see that's not working. They're going to have to go through the haircut, the creation of a bad bank that takes on a lot of bad debt, and then the years it will take off to work it. We're going to see Chinese households pull back on spending, they've increased savings to astronomical rates, and what's driven growth, export-oriented growth, inward investment, is just not going to be there for them. So it may seem odd to people listening to this right now. U.S. is probably going to be the star of the show in the global economy for the next few years.
Okay, well, I'm feeling very hopeful about the U.S. economy, and I'm feeling very educated, thanks to both of you. So thank you for talking about this changing economic landscape. Joe Brusuelas, Chief Economist of RSN, and Neil Bradley of the Chamber of Commerce. Always illuminating, helpful advice. Thank you both.